why do people set up trusts? Like, what problems are they solving, or what benefits are they trying to get from using it?
This is the interesting stuff. So I guess number one is tax flexibility. Everybody loves a bit of tax savings. The main vehicle for that are what's called discretionary trusts, aka family trusts, what they are exactly. So basically, if you have a husband and wife, husband's in the top tax bracket, wife's in a lower tax bracket, or vice versa, as you see these days, is that you then have the ability to distribute some of that trust income to the individual or the spouse in the lower tax bracket. And obviously the benefits of that, tax savings. So you're talking about potentially being in the tax-free threshold, one of them, or other individual being in the top tax bracket of 47%. So they might be paying 47% on the dollar, whereas the spouse is not paying anything on their taxable income. So therefore you'd want to obviously look to distribute to them. That's the main benefit. Then I guess, and this is going back to the deed as well, is that you always want to see, does the deed allow you to stream income? What that means is
Welcome back to the Winner's Playbook. Billy here, and today I'm joined by Adam from Link Wealth Accounting. Trusts are one of those things people hear about all the time. Some people think they're a tax trick, others think they're only for wealthy families, but most people don't actually know what they are or when they make sense. Today we're going to break it down in plain English so you understand what a trust actually is, why people use them, and when they might be considering them. Adam, how you going? Welcome.
Yeah, thank you very much, Billy. Going well. Looking forward to talking about trust. I'm obviously here in the office today. It's very, very empty. You're in New Zealand at the moment, or you didn't end up going to the conference?
No, I'm a last minute pull out of this conference. We have had a lot of conferences this year. We were together in the Philippines just a few weeks ago with our Philippines team. And then I had another one on like alternative assets, like private equity funds and all that stuff. This week we've got, it's not AMP anymore. It's called Acumen. It's our licensee. And they've got a big advisor conference in Auckland. Everyone's there. I had to bail at the last second because of an unwell family member. So that's my father-in-law. So my wife's up in Brisbane. I'm here doing single parenting with two boys. Right. It's just pretty intense. Yeah. Have you experienced that?
Full on, yeah. I mean, we've got a little 10-month-old at home. He's just gone into daycare for the first time. So I can't imagine what it would be like to be alone with just him, but you've got two. So, yeah.
That's sort of like, some things are easier and some are harder, right, as they get older. Like, you're not getting woken up at 3 a.m. and you're not doing 1,000 nappies, but you're debating, you're arguing, you're saying, guys, school's about to start, like, we have to go. There's no choice here. Like, I need to get out to put your shoes on, like all that sort of stuff. So
yeah, I've got a bit too. I'm in for a bit, aren't I? So strap myself in for that. At the minute, it's just nappies and feeding and early nights for us. But I can't imagine what it's like. So one step at a time, I think.
Yeah, that's it. We've gone, and you get flashbacks from when you were a kid too, because I'm at the point now, my older child is 7, like he doesn't want to get up some mornings. So you're turning like smashing the curtains open, turning the lights on, making noise in the kitchen to try and get them moving. And then you come in, he's still just got his head under the blanket. You're like, Max, let's go. So anyway, you got to think of reasons to motivate them.
Yeah, that's it. Yeah. Maybe, I'll need a bit of advice from you, I reckon, down the track. So,
you'll know. Yeah. We're still looking at how to do it. Still don't know how to do it. I'm just trying my best here.
Yeah, that's it. That's what it's about.
All right. Well, let's get into this topic. So we're talking trusts. So I'm a financial advisor. You're an accountant. So we both deal with trusts. You're probably more in the detail, nitty gritty, and dealing with the tax office, whereas I'm just looking at like the higher level for clients. Do we think we need a trust? And often we'll, like, as advisors, we might think, oh, maybe this person could benefit from a trust or a company set up or whatever. But we're always then turning to a good quality accountants to get some feedback on that before we go ahead.
Yeah.
So for
We're
people listening,
constantly,
yeah,
we're just to jump in there, we constantly chat on a daily, me and you, regarding trust. So yeah, it's be good to get this all out today and let you guys out there know what we do. So sorry to jump in there, Billy, but yeah,
no, you're spot on. And clients don't, and you know, it's not surprising that clients will sometimes trying to figure out who do I need to speak to, advisor, accountant, like at what stage of the process. So to kick off with, what is a trust, like in simple terms, and how is it different from, say, owning something just in your own name?
yeah, yeah. No, so trust, it's a bit of a different concept. Trust is not actually a legal entity in its own right. Trust is more a legal arrangement. So, in simple terms, you've got your trustee who holds and manages our assets for the benefit of another party, and that other party is known as the beneficiaries. You can have multiple beneficiaries. Usually, it's the family. Um, and then what the document that holds together this arrangement is called a trust deed. And this is a legal document which sets the rules and arrangements. And it's something as accountants, we constantly refer back to the deed. It's always, what does the deed say? What does the deed say? What does the deed say? So the deed is that, I guess, Bible for trust. And it sets out the rules there. And then, as I said, a trust in itself is not a legal entity. But then you've got the trustee, and the trustee can be either an individual, which we generally don't recommend to have our clients set up in that way, or it can be a company. And we'll chat about that maybe a bit later. But a company trustee, we call that a corporate trustee, and that provides a bit of asset protection, etc. And I think we'll go into more depth there in a bit. But in simple terms, trust is an arrangement, and that's where it differs from being a separate legal entity.
Yeah, cool. And you spoke about the trust deed, which is
Yes.
probably something I'd say as advisors, we probably don't think about that enough. If someone set up a trust, 20 years ago, 30 years ago. So
Yep.
do you see times where there's issues because they've got these ancient trust deeds and
You know,
perhaps
it's
they're doing things with that trust that they shouldn't be?
Yeah, well, trusts have a finite life, and it's actually, set out in the deed. And funnily enough, a few years ago, we always read old deeds because you need to make sure that there is the deed allows for distribution of income in certain ways. It allows for X, Y, Z. So it's very important that as accountants, we know what we're looking for and that we look into the deed. Now, one of the things that I came across was that this specific deed was actually vesting. So the trust was going to vest w- within a year from when I had read it. So
What is that? It means the end of the trust, does it?
end of the trust. So what that would mean is that so it was very strange, and it wasn't usually trust the deeds vest within 80 years. So that's the common period that's set out in a deed. But in this case, the trust was only maybe 10 or 20 years old, but for some strange reason, it was vesting within a year's time. So I don't know what the original purpose of that structure or that deed was, or that trust. But lucky I caught on to that quite early, because that could have been disastrous. Because once it lines up, then you got to distribute out the assets, and there's other accounting and tax implications there. So, yeah, lucky we caught on to it. But that's why it's so important that we always look back to the deed. These days, deeds are very much, templated. So
Yeah.
although it is important to have the right accountant, the right lawyer to draft the deed, most deeds these days are templated and include all the common clauses. You're spot on, Billy. It's always looking back at, those 20, 30-year-old deeds. You're always going to pick up something funny. So
Okay, and that one that was gonna vest, can you just give it a life extension, or do you
yeah,
have to set up a new structure?
yeah. So we got in touch with our lawyers at that point in time, and so they managed to extend the life of it in that scenario. There's obviously legal ways to go about that. You can do amendments to deeds. So yeah, but fortunately we caught on to that pretty quickly.
Yeah, awesome. Okay, and let's get to the interesting stuff here. Like, what this is what people want to hear. Like, why do people set up trusts? Like, what problems are they solving, or what benefits are they trying to get from using
Yeah.
these?
Yep, yep. This is the interesting stuff. So I guess number one is tax flexibility, right? So everybody loves a bit of tax savings in going about it the right way. And so I guess the main vehicle for that are what's called discretionary trusts, aka family trusts. And we'll go into that a bit later, I think, but what they are exactly. But basically, what they allow you to do, as the name suggests, is you have the discretion. The trustee has the discretion to distribute to its beneficiaries um, as per the deed or the minutes. And so basically, if you have a husband and wife, husband's in the top tax bracket, wife's in a lower tax bracket, or vice versa, as you see these days, is that you then have the ability to distribute some of that trust income to the individual or the spouse in the lower tax bracket. And obviously, the benefits of that are tax savings. So you're talking about, potentially being in the tax-free threshold, one of them, or the other individual being in the top tax bracket of 47%. So they might be paying 47% on the dollar, um, whereas the spouse is not paying anything on their taxable income. So therefore, you'd want to obviously look to distribute to them. So that's the main benefit. Then I guess there's further things you can do in that regard. So, and this is going back to the deed as well, is that you always want to see, does the deed allow you to stream income? So what that means is to stream income, you're looking at things specifically capital gains and franked dividends. Okay, so give you an example. Say one of the husband or wife they sold an investment property that was in their name only long time ago, and they made a capital loss, right? And that's been sitting there for many years. And then what's come along is they've then made a capital gain, sold some assets in a trust that they held. Then what they can do is they can specifically distribute that capital gain in the trust specifically to that individual and offset the gain against the prior year losses. Now, that's another way that you can distribute, and that's what we call streaming. So, yeah, to recap, that's number one, tax flexibility. Number two is asset protection. Okay, so again, we kind of spoke about the trust being an arrangement between the trustee and the beneficiaries. So the trustee can be a company, and this is what I was saying to you before, Billy, is that we see this a lot with the advisors, is they're constantly recommending a corporate trustee. So that being the trustee is a company, and then the individuals would act as directors of that company to maintain control over the arrangement. But the trustee in itself is a company. It is treated as its own separate legal entity. And what that means is that it's protected under what's called the corporate veil. So this goes back to tax law 101.
Yeah.
Probably I can hear you laughing, and that it probably reminds you of your uni days, right? So when you're protected under the corporate veil, it basically says that you treat it as a separate entity. So if if a creditor was to come after your assets personally, they wouldn't be able to go after the assets of a company because that's a separate legal entity. So this is, you know, so valuable in that it provides you with that bit of protection. So I've seen businesses where they've been sold and the buyer who's buying that business has actually bought it in their own name. Now, this is something that I would never recommend to unless there's very little business risk that could potentially happen. You'd always want to structure your business affairs with a company, and if you were to trade your business out of a trust, you'd look to set up a corporate trustee. So that's what that is. That's number two. So asset protection, and I guess number three, there's some other estate planning advantages. So the benefits of trusts are that they go, um, they you can change the trustee, right? So you might have one individual or company as the trustee. You can change directors of that trustee, or you can specifically change the trustee. Whereas the trust will maintain its own assets and portfolio. So therefore, it allows for easy transition of wealth from one generation to the next, or um, whatever it might be, whatever your goals might be. That's one of the benefits. The other benefit, and I think we'll talk about it later, is testamentary trust. So basically, testamentary trust comes into existence after an individual dies, and it's set out in their will to form a testamentary trust. What will then happen in a testamentary trust? It sets out a certain arrangement where certain individuals or beneficiaries can only access those assets once they reach a certain age or whatever it might be. So there's certain estate planning advantages there. I think we'll talk more in depth there. So to answer your question, there's heaps of benefits to trust, obviously, or else we wouldn't hear about them. Those are the three main ones.
Yeah, and it's a pretty good summary. On the tax efficiency, and one thing that's worth noting, which a lot of people don't understand, is like you've got that flexibility each year, right? Like you've got assets in this trust, they generate income and gains and losses. Each year you can decide in hindsight, like which beneficiaries you want to stream that income or those capital gains or losses to.
Yeah, yeah. It's so
Or at
funny
the end
that
of
you.
it's like at the end of the year, right? You don't have to decide at the start of the year. Is that correct?
Well, it's so funny that you brought that up because
That is an issue, is it, with the ATO?
yeah, it is an issue. So what you're supposed to do is you're actually supposed to create minutes or a resolution at the end of the year. So the trustees are supposed to gather and determine who they're going to be distributing prior to 30 June each financial year. And then they formulate a minute or resolution which states, we're going to define income as this. We're going to distribute to beneficiary A, beneficiary B, um, beneficiary C, and these need to happen and occur prior to 30 June. And this is a big issue because people don't do that, right?
They
They
backdate those minutes.
Yeah, exactly. They just think,
Yeah.
okay, we can change our distribution next year, right? So, and circumstances, obviously they get racked up at 30 June and the financial years ends at 30 June, but often people don't do tax planning, right? They don't really know what's gone on at 30 June. They don't really know exactly what's occurred, what their income is for that year, how they're going to best distribute it. So this all goes back to having a good accountant and somebody who can do tax planning with their client, or they're at risk. They're at risk that if they don't prepare these minutes, what can happen is the ATO can turn around and say, well, we're gonna tax this income in the name of the trustee. And what they do is they will do it at the top marginal rate. So that'll be 47%. So you might go from wanting to distribute to one of your family members at the lowest tax bracket, being a tax-free threshold, to having to pay 47% tax just because you didn't prepare these minutes and didn't have this meeting at the end of the year. So yeah, it's funny that you brought that up, Billy. Is that something that you've encountered yourself, or did you know about that when you brought that question up?
I didn't know. I didn't have a lot of detailed knowledge on that, but we see with clients like they haven't even like their taxes are done, March, April, May, even later for the year, the
Yep.
financial year prior, and there often hasn't been any planning or intention around what's actually going to happen until that point.
Yep.
Very, very reactive, right? And that's a lot of issues that we see reactive
Yeah.
rather than planning ahead.
Yeah, and I guess, that or even the issues that I've just mentioned, that would probably pose an issue to you as a financial advisor as well, not knowing what's occurring until maybe 9 months after the end of the year, So it goes back to the whole tax planning session that we like to hold with our clients. Provides clarity to the client. We're able to prepare those minutes, provides clarity to the advisor, such as yourself, Billy. And yeah, keeping the client above board from a legal perspective, minimizing risk, so that they're not taxed at the top marginal rate. Yeah, all of these things add up. So yeah, very interesting that you brought that up.
Well, we see that all the time with new clients coming in. If they have a business or they have a trust in place, very, very common that either, like you say, like I'll often ask, okay, how much do you owe tax? Right? Do you owe tax for last year? They don't know. Sometimes they're sitting on a lump sum of cash and they're hoping it'll be enough to cover the tax bill. Other times they come in, they're like, oh, yeah, I'm on a payment plan with the ATO because they don't know, they haven't prepared at all.
Yeah.
Taxes have finally been lodged late. And then it's, oh shit, we owe 60 grand.
Yep.
Yeah,
Exactly
happens
right.
all in time. Yeah.
And they might
Busy
have
running
had
business. Maybe you don't have the best accountant on board. And yeah, you find out these things when it's too late.
Yeah, exactly right. And they might have had an amazing year that year comparatively to the prior year, and they've got all this additional tax that they need to pay, right? But they're not paying the correct amount of installments throughout the year. So again, this goes back to tax planning, and the whole benefit there. Yeah, it's all interrelated, isn't it? So, um, yeah.
Yeah, 100%. And then, so there's different types of trusts. So there's the discretionary trust or the family trust, probably the most well-known form of a trust. Then there's the testamentary trust, which is you set that out in your will that's created upon death,
Correct.
which is super valuable if there's children involved as beneficiaries or
That's
or
right.
even young adults where you don't want them, in the event of your passing, you don't want $1 million landing in their bank account. You'd rather have that under control and sort of,
That's it.
yeah, sent out to them over time or when they hit a certain age. So that's the testamentary trust. Are there other common types of trusts in Australia that people use?
Yeah, there's also, so you summed it up pretty well, Billy. The other one is a unit trust. Um, Maybe I'll give a brief background of all those because I have given a little bit of background, but um, you would have definitely, the most common trust you would have heard of is a family trust, right? And this is the most common vehicle. What a family trust is really a discretionary trust that has made what's called a family trust election. Okay, this is something we do as accountants for our clients. The reason you do a family trust election is generally we see, and this is what you do a lot, Billy, is you'd, if worth it, you'd have investment portfolio in a family trust, right? Now, that investment portfolio generally earns income, and often it would receive dividends or frank distributions, which have franking credits attached to it. Now, if the franking credits received is greater than 5,000, then you need to create a family trust election. Okay. The other reasons you do that is if you were wanting to, and I won't go into depth here, but there's an opportunity to distribute to a bucket company, companies pay a flat tax rate of 30% if they're not base rate entities. So there's a benefit there to distribute to a buck company, but you need a family trust election to do that, because you'd need what's called an interposed entity election to make that distribution. So that's another reason you'd want a family trust election. And the last one is, and probably less common, but if you want to access prior year losses in a trust, it's easier when you have family trust election. Now, what is a family trust election? It's basically you're electing a member of your family to be that key individual. And then what it's saying is that all distributions in future have to be to the direct family members of that family member. So that's what a family trust is. You probably don't hear discretionary trust as much, but a family trust is just another word for discretionary trust with a family trust election in place. So then there's what's called a unit trust. So a unit trust is similar to a family trust or discretionary trust, but unlike a discretionary trust, the trustee doesn't have the discretion to distribute to different beneficiaries. The entity or individual receiving the distribution, the beneficiaries, they're based on what the unit holding is. So it's just like a company where you've got shareholding, but instead you've got unit holding. Now, why would you want a unit trust? Well, I guess the most common reason we see unit trust is when you've got an investment property or some sort of investment portfolio where you've got unrelated parties.
And they're not a family.
It's not a family.
So you've got a fixed entitlement.
Exactly right. Fixed entitlement, that everyone knows what they're going to receive from a distribution standpoint. They all know how much they own in regards to the assets within the trust, and it's fixed, right? And that's what a unit trust is. It's fixed. So the benefit, I guess, is with you see discretionary trusts and unit trusts, or trust in general, as a vehicle to hold investments. Now, why do you see that? Well, you see it because there's what's called the 50% CGT discount, where if you distribute from a trust to an individual, you still have access to that CGT discount. Now, if you were to hold those investments in a company, you wouldn't have access to that 50% CGT discount. Although there's a lot of talks in the media currently regarding properties and the government looking to get rid of that discount for properties, there's still a benefit there, right? And so that's what we see. Family trust, usually you have related parties. Unit trust, usually you have unrelated parties, but both vehicles used for investments. And in summary, that's what we see most commonly with trusts, are those two sorts of vehicles. And then lastly, we've touched on it already, testamentary trusts are the other most commonly used trusts, where you've got obviously somebody's passed away and they set out in their will for there to be a testamentary trust to open on their death. This therefore would be used as a vehicle to, maybe you don't want somebody to access money until they reach a certain age, or until they reach a certain milestone, whatever it is. So that's the benefit of testamentary trust. You have more control over how your assets will be used in future. And I guess the main tax benefit of a testamentary trust is if the beneficiaries are actually children. So children are generally deemed to be, what's the name there?
They're minor.
Yeah, minor person. It's actually called a person under legal disability, right? So they basically can't make decisions for themselves, in summary. So generally, if you can't distribute from a trust to a minor, someone under the age of 18. But where testamentary trust comes into play and is of a lot of benefit is that when you do distribute income to the minors or to the beneficiaries who are minors, then you can treat them as paying tax at adult marginal tax
It's
rates.
normal
Right.
tax rates. Yeah.
Exactly right. So there can be massive tax benefits from that perspective. And we see that you utilize a lot from an estate planning perspective. And we deal a lot with testamentary trusts. And it's a fantastic vehicle, actually. So in summary, three different entities: discretionary, aka family trust, unit trusts, and then we got testamentary trusts as well. There are others out there, and there's other arrangements that can take place, but those are the main ones.
Okay, and I think it's worth touching on the investment company or the bucket company. This will
Okay.
become, I think, even more popular if the government has a crack at that CGT discount. Because although when you invest through a company, you don't get a CGT discount, you do have a flat tax rate of 30%.
Correct.
So if you have a couple who are both high income earners and they're in that top tax rate, or if you have a business that is quite profitable, having this company, if you have like a family trust, distributions go into this company. Now that tax rate's capped at 30%.
Yes.
That's going to be, I think that'll become more and more popular. What are your thoughts on that?
Yeah, you've opened a whole can of worms there.
Well, let's do a separate podcast and bucket companies, but
Yeah, I think so. But in summary, like Josh, who is usually on, I'm taking his spot today, but he's released this video that basically shows the monetary benefits of a bucket company. Um, and yeah, you're spot on. You're getting taxed at a flat 30%. Now, the some of the problems that can exist with that are that there's potential Division 7A implications that can occur. So the ways to get around that is if the money actually follows. So if the money that gets distributed from the trust follows to the bucket company, then there aren't any loans that exist. So there aren't any Division 7A implications there. Division 7A, in summary, for those out there listening right now, is basically a, a section of the legislation which prevents you from having a loan between a company and a trust, or a company and an individual. Okay. And it's basically saying that you're getting that tax savings in your trust of only paying 30%, only paying 25% if it's as most small businesses do. But you're getting a tax saving from not having to pay at, say, your top marginal rate of 47%. So there's a form of tax arbitrage that's occurring there. So there are just 7A implications. Funnily, this whole chat is before the courts. So what happens when you distribute on paper is you create what's called a UP, an unpaid present entitlement. This whole thing that you've just brought up, Billy, is actually before the courts in what's called the Bendels case. I won't go into detail there, but there's certain things that are happening in that space. The whole industry is kind of shifting, and we're kind of seeing a lot happening. It's been going on for over a year now, so we're still waiting on the results. It's now gone to a higher court, and we'll see how that plays out. But there are certainly benefits that can happen, especially when the money follows, is the important thing. And yeah, there's obviously that benefit of only paying 30% instead of paying 47%. So go check out Josh's video. It's
that was actually that Josh's work on that was really good. Because in essence, it was saying, like a lot of people say, well, I won't use a company because I don't get my capital gains tax discount. But the point there was when the money flows into the company, it has not yet been subject to that top marginal rate of 47%. So so the cash is in there. It hasn't had that top tax rate applied. And the benefits of that outweigh the fact that you won't get a CGT discount in the future when assets are sold.
correct.
And probably the only other thing to say is like when I present that to clients, they might say, well, yeah, how do I get money out of the company? Good point. Yes, you'll still have to pay top tax rates, but an investment company should be used to invest long term. So you don't put money in that company that you're actually going to need or want to spend. It's a long term wealth creation strategy, right?
Exactly right.
Yeah.
That poses the whole issue is when you're pulling the money out from the company, then what happens to the money? How does it get taxed, right? So, yeah, you're right. This strategy has its place, and its place is looking long term.
Yeah.
Where
It's one component. So you're still going to have income that streams out to individuals, which you'll use day to day and short term. But for long term wealth creation, that's where the company can sit there, and there's some big benefits in doing that for depending on your circumstances. I've got a bonus question in here because this comes up a bit. So apologies if you haven't prepared for this, Adam, but I'm sure you'll easily be able to answer it.
no worries.
In what situation, or what's an example of a situation where you should use a trust to purchase a property, like a residential or commercial property?
Yeah, yeah. Well, this goes back to the whole asset protection standpoint. So obviously, the main disadvantage of purchasing a property in a well, there's actually let's look at it from two perspectives. So if if the property is your primary place of residence, okay.
Do not put that in a trust.
Well, not always.
Not always.
Not
Not
always.
always. All right.
So yeah, if you do put in a trust, you lose out on that CUT exemption, right? And so that's why generally you don't have people owning their own properties in where they live in it and they treat it as they nominate it as their primary place of residence, aka PPR. They have that in their individual name, right? But say the individual was in a very high risk profession, right? I've seen circumstances where people decide the benefit of losing that primary place of resident exemption and having to pay CGT on it outweighs having it in their individual names, so they have the property in a trust. Okay, so there is an asset protection point of view. Obviously, you're going to have a corporate trustee there.
They pay
So
land tax as well.
Yep. Yes, land tax. And certain circumstances you might actually pay um higher. There's other tax implications from a state perspective as well. Won't get into that today, but so that's talking about your primary place for it. Then the alternative is say you had an investment property, right? Now would you want it in a trust, or would you want it in your own name? And I guess there's the asset protection standpoint. So you look at it from that perspective. Are you a high risk individual? Are you a doctor? Is it worth putting in a trust for that perspective? From a tax saving standpoint, it might also be worth it. So to run and operate a trust, and it's not just for a property, it could be you're putting a portfolio of assets, one that you might arrange for a client, Billy, for whatever platform that you use. You might decide, okay, it's more beneficial to have that in a trust rather than an individual's name in their individual name. So you got to ask the question, well, what are the costs of operating a trust? And the costs of operating a trust are generally between $2,000 to $3,000, additional to what if the assets were in your own name, roughly per year. Can go higher, obviously. But roughly that's what we see is the case, and that includes compliance costs from an accounting standpoint. So what we do is we prepare tax returns and financial statements. We obviously need to arrange. You need to pay ASIC if you've got a corporate trustee, and then you also need to prepare the distribution minutes that we do before 30 June every year. And so if the benefits outweigh that $2,000 to $3,000, then it's worth it. That's how simple it is to figure it out. So, I guess you just need to really ask yourself, well, can we distribute or stream certain incomes to certain individuals or certain beneficiaries, where we would receive a tax benefit greater than that. And that's the answer to the question. Really, it's does the benefits outweigh the costs?
Yes, and that's changing, right, with the ATO and how they're looking at trust, and it may change again. I know the topic just keeps coming up. So probably worth touching on distributing to children because that used to be extremely common, right?
Yeah.
Just
Yeah.
family trust, distributing to kids.
Yeah.
Obviously, if they're under 18, it's not really worth it because they pay those higher tax rates. But a common strategy would be big distributions to the kids who might be 18 to 25 years old, whether at uni or they don't have much other income.
Yeah.
But the issue raised a couple of years ago is that usually that money is not actually the child's not getting that money, right? It's still staying in the trust. They're just paying tax on the trust distribution. So yeah,
Correct.
what's the
Yeah.
latest? The latest there?
Yeah, so not much has changed recently, like in the last year or so. But what happened, as you just touched on a few years ago, the ATO spoke about this, and what had happened was, on paper, we were seeing mothers and fathers distributing to their adult children, so children above 18, right, who can receive distributions, um, who were at uni paying less. Um, in lower tax brackets, so they were distributing it there, but the money wasn't following. So the money would go to the parents and they would pocket it themselves, and the children on paper would receive the distribution, right? And this was common. This happened for a very long time. Okay, and what would be argued is that since the kid was born, the parents were paying for school fees, paying for cars, paying et cetera, right? You know all about it. You got two little ones, right? And I'm currently learning. But this, and so the idea was that we paid all these fees over all these years, we can now claw back that. We'll distribute the income on paper to them, but keep the money ourselves because they owe us essentially that money, right? So
Yeah.
yeah, it sounds very funny and very comical, but this is what happened. So then, what the ATO did was they brought back this old legislation, okay, and it's called Section 100A, right? And there was a big uproar in the accounting community because for a very long time, trust had been used as this vehicle to distribute to children. And all of a sudden, the ATO reinterpreted this old legislation, Section 100A, and basically said that no, just because you pay these school fees, you bought a cars for your children. No, you can't just all of a sudden distribute to them without the money actually following to the children, right? So this has caused a big shakeup. Now, what we need to do is we need to have these conversations with our clients, basically say to them, well, you can't just distribute to your children and pocket the money, right? If you get caught, well, we're still waiting for there to be a test case.
Yeah. So no one's actually been pulled up on this, but they've issued all
No.
sorts of warnings and guidance around it, right? This traffic light system and all this stuff.
Exactly right. Yeah. So the ATO has given us this traffic light system of how you'll be protected if you are deciding to distribute to your children or potentially even to a bucket company, right? This Section 100A comes into play. If the money doesn't follow, right? The money has to follow. But I guess the bottom line is that you can still do this, right? You can still distribute to your children, but you need to really sit down with your accountant and really understand, well, what are the implications here? How do we, what it comes down to is proper documentation, right? So are we basically saying that we're not going to distribute, the money's not going to flow to the children now, but when maybe they're 28 years old, they're going to want to purchase a property. And because we love our children, we're going to want to help them buy that property. So there's still a reason or there's still, you can still distribute to your children, but you need to have that documented correctly.
So you could say the money will flow to them in 5 years' time, but I'm going to do the
Correct.
distribution this year for tax
Exactly,
purposes.
exactly right. Exactly right.
And
But
then what
as
happens? Then what if you don't? What if you change your mind?
what if you change your mind? So what will happen is there'll be a on paper. So as I said before, we prepare financial statements for all of our trusts and companies. All of our trusts, and on paper we'll have to draw what's called, and I spoke to you about this a second ago, what's called a UPE, an unpaid present entitlement, which basically is not a loan, because I don't want to get technical in that, but it's basically, as the name suggests, an amount that's owed from the trust to the beneficiary. In this case, the beneficiary is going to be the adult child. Now, what can happen is down the line, the child can actually turn around and say, "Hey, I'm owed that money, right?
Yeah.
Where's the money? Fork it up," right? So,
Yeah.
obviously we don't like to see family disputes, but that's one scenario that can happen. Again, this hasn't been before the court, so we're still, we don't know exactly what would happen, but we would assume that there would be some pretty negative implications if this was found to, be drawn up a certain way, documented in a certain way, and then played out in a separate way. So, yeah, look, again, it comes back to documentation, comes back to having that discussion with your clients. It comes back to really understanding what this all means to your specific circumstances. Yeah, the hot topic, Section 100A. It's so funny you brought that up, Billy. But yeah, there's that I'd say is one of the real implications of running a family trust. That's where we step in as accountants.
I see. And do you know what? Years ago, my dad had an accounting business, and he did what all good accountants were doing, and had the family trust. And I turned 18, and unbeknownst to me, distributions were flowing, but the cash wasn't in my account. And he accidentally paid off a big chunk of my HEX debt because he didn't realize, he didn't factor in that I'd just done it my first year of uni. And he said,
Perfect.
"I've just paid off some of your HEX." I said, "Well, I don't have any money, so thank you for that."
Perfect. That's what you know.
We moved on. So I did get some benefit at least. That was good.
Yeah, yeah. I don't know if you're named as a beneficiary or if there exists a UPE. Maybe you can have a look at the financials from
2003.
2003. Yeah, have a look. That's it.
All right. Okay. Well, I think we're about to wrap this up. Is there any points we've missed here, Adam? Or do you think we've?
Yeah, I think we've covered off basics plus more. So
We have. We've gone on a few tangents, but I think it's good for people to know it's not simple, because we get the question all the time, like, "Oh, I want a family trust," just because I've seen stuff on social media or their mates told them they have a family trust, and it sounds like some amazing thing where they're just going to save all this tax.
yeah,
In some cases it is, but in a lot of cases, as you say, there's cost and complexity involved. So sometimes it's worth it, and sometimes it's a great tool, but it's also it's easy to stuff it up, especially now with the ATO cracking down on it.
yeah,
I'd say even the next budget we've got in May, I have a feeling they might turn the screws up further, or at the very least look at CGT discounts and so on. So we'll keep an eye out.
yeah, yeah.
All right. So yeah, for sure. So we'll wind things up. So a trust can be a powerful structure when it's used for the right reasons, but it's not something you just set up because someone told you it saves tax. So the key is understanding what you're trying to achieve first. So if you're building wealth, running a business, or thinking about long-term family planning, getting the structure right early can make a huge difference. If this is something you've been thinking about, please reach out. We'll help you work through the options. Thank you so much for joining us, Adam.
Thank you, Billy, and thank you, everyone. It's been an honor to be over here. Hopefully, I've filled the shoes of the great Josh Lee, but we'll see how this all plays out, and I appreciate your time.
Thanks, Adam.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.